Today we'll cover the market reaction to further trade tensions. Yesterday we saw an increase in the trade tensions between the US and China, with the US now placing tariffs on China at a rate of 104%. Now this comes when we've seen China retaliate against the US's original tariffs of 34%, so they'd matched the tariffs, and Donald Trump had threatened if China did this, he would increase the tariff rate. So that's what we've seen happen yesterday. Now, how have financial markets reacted to this news? Well, we've seen market participants continue to reduce their global GDP estimates, and that has fed through into equity prices, with US equities closing lower yesterday and European equities opening lower this morning. However, we'd like to highlight that this environment is much different to what we saw within 2022. The impulse that we are seeing is actually deflationary, with things like oil prices falling to below $60 per barrel. So this is likely to cause a difference between the US and Europe, where US is likely to see a more inflationary outcome from the tariffs, but Europe's likely to see lower rates of inflation, which will allow central banks to reduce interest rates further from here. We'd like to highlight as well that coming into the year, the backdrop for the global economy was fairly strong, with growth and GDP growth being high and inflation moving lower. So the deterioration in growth we are seeing is primarily due to President Trump's tariffs. So these lower GDP estimates could also be revised higher should we see a pullback in the tariffs from the US. Thank you for watching today's video, and we'll catch you in tomorrow's episode.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.